Most people who want to build wealth start by asking the wrong question. They ask what to invest in. The better question, the one that actually determines outcomes, is when. Because every financial asset has an effective return, a yield. Some have hidden yields nobody advertises. Some have yields so good they shouldn't legally exist. And most people, through no fault of their own, deploy their money in completely the wrong sequence, skipping the high-yield plays early, arriving late to the compounding game, and wondering years later why their net worth didn't move the way they expected. What we're going to break down today isn't a list of tips. It's a system. A specific sequence of asset deployment ordered by effective yield that turns every dollar you save into the most mechanically efficient version of itself. Think of it less like financial advice and more like a build order. In any game with resource constraints, deploying resources in the right sequence is often worth more than the resources themselves. Let's start at the bottom rung. The first dollar you build wealth with has one job: survive. Not grow, survive. And the asset that does that job is a liquid emergency fund, 3 to 6 months of core expenses, sitting in a high-yield savings account. Right now, that's earning somewhere between 4 and 5% annually in most environments. Not exciting. But that's not the point. The point is that without this buffer, every unexpected expense, a car repair, a medical bill, a sudden job gap, gets charged to high-interest debt. And high-interest debt is a yield-destroying machine running in reverse. When you don't have a cash cushion, you're not investing, you're gambling. Because one bad month unwinds 6 months of gains. The emergency fund isn't passive savings. It's the prerequisite that unlocks every rung above it. Skip it, and the rest of the build doesn't open. Once that buffer exists, the second rung is the one most people intuitively understand but systematically underestimate. High-interest consumer debt, specifically credit card balances carrying rates between 18 and 28%, is not a liability problem. It's a return problem. Paying off a 22% debt is a guaranteed 22% return on that capital, tax-free, zero volatility, no counterparty risk. No diversified investment portfolio in history has reliably returned 22% annually. The S&P 500 has averaged somewhere between 8 and 10% depending on the time frame you use. Paying down high-interest debt beats the market by a factor of 2, and nobody talks about it like that because there's nothing to sell you. This is the first counterintuitive truth embedded in the ladder. The highest guaranteed yield available to most people isn't in the market, it's in their existing debt structure. And the minimum payment structure makes it worse than most people realize. Credit card companies don't design minimum payments to help you get out of debt. They design them to keep you in it as long as legally possible. A $5,000 balance at 22%, paid at the minimum, takes over 15 years to clear and costs more in interest than the original balance. That's not a debt. That's a second mortgage on your own spending history. Clear it before you invest anything else above a 7% interest rate. The math isn't close. Now we arrive at the third rung, and this is where the system gets architecturally interesting. If your employer offers a 401k match, any match at all, you have access to a return that is, mechanically speaking, unlike anything else in the legal financial system. An employer that matches 50 cents for every dollar up to 6% of your salary is handing you a 50% instantaneous return on that contribution. Before market exposure, before compounding, just by virtue of depositing the money. And yet, a significant percentage of eligible employees either don't participate or don't contribute enough to capture the full match. They leave the guaranteed 50% return sitting on the table while trying to optimize their stock picks. This isn't a behavioral finance puzzle, it's a sequencing error. The employer match is the single highest yield asset most workers will ever have access to. Capture every dollar of it before moving up. Rung 4 is where we leave guaranteed returns and enter tax architecture, which is its own form of invisible yield. A Roth IRA is funded with post-tax dollars and grows tax-free. Every dollar of gains inside a Roth is never taxed again. If you invest $5,000 today, watch it become $50,000 over 30 years, and withdraw it in retirement. You pay no tax on that $45,000 in gains. The IRS gets nothing. That's not a metaphor. That's the legal structure of the account. The reason Roth contributions come before maxing the traditional 401k for most people, and this is the sequencing insight that gets missed, is that tax-free growth is more valuable in your youth than in your peak earning years. Younger contributors have more years for Roth gains to compound tax-free. Older, higher-income contributors may actually benefit more from the traditional 401k deduction. The latter is not a one-size model. It responds to your specific tax situation. But for most people starting from zero, Roth before traditional is the right sequence. Adjacent to the Roth IRA sits one of the most structurally underused accounts in the entire tax code, the health savings account. If you have access to a high-deductible health plan, you can contribute pre-tax dollars to an HSA, invest them in the market, and withdraw them tax-free for qualified medical expenses. That's triple tax advantaged, pre-tax in, tax-free growth, tax-free out. No other account in the U.S. tax system offers that structure. And because medical expenses are essentially guaranteed over a lifetime, the numbers on a maxed HSA are worth running. The 2025 contribution limit for a family is $8,300. Invest that annually starting at 30, leave it untouched for 30 years at a 7% average return, and you're looking at roughly $800,000 in tax-free medical spending power by retirement age. An HSA maxed consistently and invested aggressively in index funds functions as a stealth second retirement account. It doesn't get marketed like one because there's no product wrapped around it. Just the mechanism. Once employer match is captured, Roth is funded, and HSA is maxed. Now you go back and finish maxing the 401k. For 2025, that's $23,500 in employee contributions. At this point, every dollar in the traditional 401k reduces your taxable income today and grows tax-deferred. You're not dodging taxes, you're timing them, moving the tax event from your high-earning years to your retirement years, where your marginal rate will likely be lower. This is the architecture of tax-advantaged accounts when viewed as a system. They are a sequence of yield enhancements stacked on top of each other, each one reducing the friction between your labor and your long-term capital. After all tax-advantaged space is filled, and for most people, fully using this space is a multi-year project, not a weekend task, you enter the taxable brokerage account. No special tax treatment, but also no contribution limits, no income restrictions, no withdrawal penalties, total flexibility. Capital gains are taxed, but long-term gains are taxed at a lower rate than ordinary income. In a taxable account, asset location matters. Holding tax-efficient index funds here, rather than high-dividend or actively traded assets, reduces the drag. The taxable brokerage is where wealth begins to feel less constrained. It's also where individual stock selection, sector bets, and more complex strategies start to make structural sense, because you're building on a foundation that already captures all the high-yield guaranteed returns, all the tax-advantaged leverage, and all the compounding surface area that exists below it. Above the brokerage sits real estate, business ownership, and alternative assets. Real estate specifically operates on a different mechanical logic than everything below it on the ladder. When you finance a property, you're controlling an asset worth several times your actual cash outlay, and the tenant's rent is servicing the debt while the underlying asset appreciates. The depreciation deduction lets you show a paper loss on a cash-flowing property, reducing your taxable income while the asset gains value. That combination of leverage, cash flow, appreciation, and tax treatment doesn't exist anywhere else in the system. But it also requires capital for down payments, operational involvement, and tolerance for illiquidity that none of the lower rungs demand. Getting to real estate too early, before the foundation is built, is a common pattern among people who make good money but struggle to build lasting wealth. The top of the ladder has the highest ceilings. It also has the least margin for error. Here's the uncomfortable math that ties all of this together. The order in which you build this ladder matters more than the individual investment decisions you make inside each account. A person who captures the full employer match, maxes their Roth, funds their HSA, and invests the rest in a single index fund will almost always outperform a person with a sophisticated stock-picking strategy who is carrying credit card debt, missing their employer match, and investing in a taxable account while their Roth sits empty. The system beats the selection. The sequence beats the allocation. This is what min-maxing actually looks like in a financial context. Not finding the best individual asset, but running the most efficient build given the resources you have. Most financial content teaches you to optimize your picks while leaving the architecture broken. There's one more thing worth naming explicitly because it shapes every rung on this ladder. Income growth is a prerequisite, not a separate track. You cannot save your way to financial independence on a fixed income. At some point, expanding the gap between what comes in and what goes out requires earning more, not just cutting more. The ladder tells you where to put the money. It doesn't generate the money. At some point, you have to be grinding for resources at the same time you're optimizing the build. Income growth and asset deployment run in parallel, and neither substitutes for the other. If this kind of systems breakdown is the way you prefer to think about money, less noise about what's hot right now, and more focus on the underlying architecture, then 8-Bit Economics publishes every week. No predictions, no hype, just the hidden mechanics of how financial systems actually function. Subscribe, hit like if this reframed how you think about the sequence, and drop a comment with where you currently are on the ladder. It's useful data, and the comment section here tends to be worth reading. By the time everyone sees it coming, the smart play is already over. The asset ladder isn't a secret. The information is accessible. What's rare is seeing it laid out as a sequence with a logic behind the ordering, understanding why the employer match comes before the index fund, why Roth comes before traditional in most cases, why debt at 20% is a better investment than most equities. The mechanics don't care whether you believe them. They compound regardless. The only variable is which rung you're standing on when they start to move.